Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and I hope that you guys all had a relaxing weekend and safe and with your families. We are about to open up here on Tuesday after a long weekend, substantially higher than where we closed here on Friday, with a real chance of breaking above some resistance levels that, if you asked me a month ago if we were going to retest, I would have said probably not. So markets are in quite an interesting state at the moment. So let's go ahead and go over where we currently stand and how we are positioning ourselves here for this particular market. Now, before I do, just a quick disclaimer. What we're going to discuss here today is purely for demonstration purposes and is not a recommendation or solicitation to buy or sell any specific securities. So we'll start off the day by talking a little bit about where the current market is. We've been talking about this market rally for quite a few weeks now. Now, for the last 4 or 5 weeks or so, the market really has been range bound between 285, 295, which is right around the 20-week moving average here. And if you look at the daily chart, we certainly broke into this particular range back here in mid-April, but have spent most of that trading within the range, kind of going back and forth. A couple of weeks ago, the market looked like it was about to start moving lower, but it quickly reversed higher back into the range. And just last week, we started to break out above towards that range. It really spent quite a bit of time consolidating last week on that breakout, but today we have a true breakout of that range above 295. We're about to open up around 301. We've been talking about 300 and 302 on SPY as a major resistance level, because 300 and 302 go back to a major resistance level that the market traded up against multiple times between April and November before finally breaking out. And once it broke out above 302, it rallied all the way up to that 340 level without really looking back during that November to February run before that initial sell-off. So that's why 300 and 302 is a major resistance level. That is a level that we're watching very closely, because at this point, a break above 300 and 302 really puts us in a very bullish stance here for markets to continue moving higher back towards all-time highs. Again, pretty incredible given the economic backdrop, given the economics and fundamental numbers that we're currently looking at. Certainly things for, I think, many investors don't really align at this point in terms of where the current markets are trading versus where they expect it to be based on whether it's economic or fundamental numbers that you're looking at. But at this point, what I want to do is I want to frame why we're trading here, how we should expect markets to look going forward. Technology, also very similar outlook. Technology is now within spitting distance from its all-time highs. This is the QQQ, or the NASDAQ 100 Index ETF. As you can see, incredible strength over the last few weeks while the equity markets have been relatively flat. Technology continues to move higher. The one thing I will warn you is that the momentum indicators have not really confirmed these continuations higher. But again, this type of exhaustion and this type of divergence can go on for quite some time before markets see some type of correction. We certainly see it here on the weekly chart where the markets are well above its 20-week moving average, never really struggled at that level at all, unlike the overall market. And again, very close, just spitting distance away from its all-time highs. My expectation is we're going to tag that all-time high and probably break above and continue on higher. So strong support for markets moving higher. It's driven predominantly based on a few different sectors driving this. You have technology, you have healthcare, and you have discretionary continue to drive this. But the discretionary, I would say, strength is fairly concentrated within a few specific names like Amazon and Home Depot. But the broader good news is that small caps have joined this rally. It is one of the fastest growing sectors currently at the moment. IWM, the Russell 2000 index, spent most of its time just trying to get back above its December 2018 lows. It managed to do that. It is testing the 20-week moving average, and I believe today it will open up above that 20-week moving average, which certainly puts it on pace to get back into that 150 zone or so. So the fact that you're seeing rallying. You're seeing sectors rally. You're seeing small cap, large cap, all rallying. This is supportive, again, of the markets continuing to move higher. So for many of us, we feel that these moves higher are opportunities to short. But again, I want to point out that the broad rallying that we're seeing, the support, the breadth that we're seeing across the board, this is all, in my opinion, more supportive of this move to continue moving higher rather than opportunities to short, despite all of the warning signs we might currently be seeing from the economy or fundamentals. That is likely not going to play out until probably Q3 or Q4, when the earnings numbers comes out and really start surprising to the downside on the recovery at the moment. So until that happens, the base case is that markets will continue to move higher. We'll talk a little bit about why as far as that. I don't think it's a surprise for most people, but it is something that we'll talk about. Number one, you don't want to fight the charts. As much as you might say these markets look overextended, valuations are at all-time highs, this is a good time to short. Don't fight the charts at the moment. We are currently testing 300 and 302 resistance. Remember, the weekly chart is extremely strong. The daily chart is fairly strong and it's just breaking out to the upside. These are all bullish indicators telling us that this is a time to potentially look for long opportunities, not short opportunities. VIX is now well below 30, so this is telling us that continuing stability in the markets from a volatility perspective, from an options perspective. Oil also stabilizing around 35. This continues to provide further support of just stability and liquidity coming back into the markets. Last week, we were looking at the markets. Normally, we see about 200 very liquid symbols, but as of Friday, we saw 319. This was really, again, further indication that liquidity is coming back into the markets. The most important thing for us to take a look at the moment is really more liquidity rather than valuations, because valuations really do not mean much at this point. And how is this all happening? How are we opening up Tuesday after Memorial Day weekend with markets substantially higher and global markets higher? It really comes down to one thing, and that's global central banks. Global central banks and the Federal Reserve have pumped trillions of dollars into the economy this year. And the language from the Fed that we saw last week, or that drove some of the investor sentiment starting Monday morning, was really the Fed's commitment to continue to do everything possible to support this crisis and support this downturn. That type of rhetoric is extremely powerful for the markets and is driving the optimism here in this market. You couple that with a few other things, such as the reopening trends. You couple that with some of the data coming out of China. You couple that with the potential vaccine from pharmaceutical companies. This is really what's driving some of this optimism and euphoria. And I will say that as much as optimism and euphoria many times may be scary going into a rally, I don't think we're near a true euphoric peak, if you will. Things will have to get a little crazier and valuations get a little bit more stretched, in my opinion, for that to happen. Again, I think this can go on for at least a few months longer before things really start to crash back to reality and we see the current disconnect between where equity markets are trading and where the economic numbers really are come back to convergence. So be careful if you're thinking about shorting this market. There absolutely are risks to the downside, whether it's a second potential wave of COVID-19 and things get shut down, or things escalate much further with potentially China and what's currently going on with Hong Kong. There's no shortage of downside risks at this point. However, at the moment, with global central banks continuing to ease, you don't want to fight the Fed, and you certainly don't want to fight the charts. So today, what we want to take a look at are some of the sectors that are actually surprising, that are doing extremely well in the backdrop of this, predominantly airlines and travel stocks coming off of the data for reopening in some certain states as well as overseas, looking, I would say, optimistic at this point, and stocks rallying as a result of that. For weeks, we have been saying don't step into some of these travel stocks until you start to see this type of until we start to see this type of number lift off, and we are starting to see that. And I think it's time to start taking a look at some of these names and at least point out some of these names. So that's what we're going to take a few minutes to take a look at, as some of those charts. So first of all, I will point out there's only one indicator that I think that really matters here, and that's how much global central banks have put on their balance sheets. So this is major central banks, so G10 currency banks that have total assets on there. As you can see, during COVID-19, you had this extreme spike to the upside in terms of assets on balance sheets. And the blue line is the total assets. The yellow line is the MSCI World Index, or World Equity Index. And as you can see, the two charts are very highly correlated with each other. The correlation here is actually 95%. So arguably, in my opinion, this is really the only indicator that matters looking at the markets here. So keep in mind that all other things that we look at from an economics perspective, in my opinion, don't mean much outside of this one indicator. So this is really the one thing that we want to keep an eye out on. As far as reopening trends, this is really what's driving some of the optimism here in the markets. Open Table, which is obviously one of the largest drivers of restaurant bookings and reservations. This is the data that we have been looking at in terms of whether or not restaurants are reopening. And as you can see, for a very long time, we saw nothing. But basically in the beginning of May is when things started to take off a little bit. And the numbers are starting to get to that point where restaurants are going to start getting some more business. And I think this is really what's driving some of the names like McDonald's, Darden Restaurants, Chipotle. Those are the publicly traded stocks that you will likely be able to gain some exposure in restaurants opening, and people feeling more comfortable getting back out there. Certainly as far as Google data, parks and groceries are really continuing to grow. People going out to places where likely they're able to do things outdoors without coming into close proximity with other people. But as you can see, workplace and transit still relatively low here at the bottom. So workplace, transit, relatively low. Retail also relatively low. But starting, as you can see, improvements here over the last few weeks as we enter June, that we're starting to get pickup. And this is, again, one of the reasons why we're starting to see a lot of these travel stocks start to rally off of their bottoms. And this is really the type of data that we're looking at. And as far as data out of China, one of the data points that's interesting to note is that 93% of restaurants are open back in China, 93%, which is a pretty incredible number. I will say that is surprising to me as far as how far they've managed to get back out there. But as you can see, order value in terms of capacity is still nowhere near. It's still probably closer to about the 60% level. And I think those are some of the numbers that, even if they're not completely accurate, they give us a pretty good sense of ballpark where we can expect our restaurants to reopen. Bank of America credit card data has been improving very much since April 15th, which is when stimulus checks and tax refunds really started hitting bank accounts here. And it's almost, over the past few weeks, just shy of about 10% below norm. So I would say on the average about 10 to 15% below normal. So certainly looking relatively strong, and again, driving a lot of the retail flow that we've seen over the last few weeks into retail stocks that we didn't think were going to be doing very well. These are some of the figures that are driving those types of thesis or those types of investments, in my opinion. So to take a look at a few stocks, and these stocks that I'm bringing up is just meant to give you a sense for the type of stocks to look at for this particular week. E-commerce, PayPal, this is one that we've talked about on Options Action for quite some time. Clear winner compared to MasterCard, Visa, American Express, because PayPal is almost 100% e-commerce. They only process credit card payments for e-commerce. Over the past few weeks, we've been talking about this bifurcation between online versus physical stores. All of the retail that was lost in physical stores have predominantly shifted to online. So payment processors like PayPal have been extremely strong during this time, and we expect that to continue to be extremely strong because, as you saw in the previous data sets, even though people are getting back out there, they're not getting back into physical stores as much, certainly not department stores. We have JCPenney potentially going bankrupt. You have Macy's selling real estate. You have a lot of these retail stocks that for a long time did a lot of business that is now going to have some trouble, and a lot of that business is going to shift online. So PayPal Holdings, certainly one that can potentially benefit. They also process payments for Uber, Airbnb, some massive travel companies that, as they start to come back online, they're also going to be a net beneficiary of those particular names. So names like PayPal, or any name related to e-commerce, servicing predominantly e-commerce, you can think about eBay, you can think about Etsy. There are a lot of names in this particular category, if you will, that if you're thinking about trading, if you're thinking about investing in a post-COVID-19 world, this is the type of thesis that you want to pay attention to. Over the next few weeks, I expect these types of stocks to do fairly well. Airlines, we've been getting questions regarding, is it time to start buying the airlines for quite a few weeks? And for the past few weeks, we've maintained our thesis that it's too early, that if you want to play some of these airlines, the best thing to do is just sell puts, because you can collect a lot of premium, 6, 7, 8% per month in terms of premium to buy these, to sell these puts. But now that the travel data is starting to come back to life a little, and we're starting to see a little bit more life of these stocks, this is time to be, perhaps to start thinking about tiptoeing back into some of these airline stocks. Delta, I think, is going to open about 5-6% higher here today on the type of news that we're showing you here today. Now that we are starting to see an actual uptick in travel, now you can start considering taking a look at some of the airline stocks. I will say not all airline stocks are the same. I would focus on the airlines that have strong balance sheets. Delta has about 11 months worth of liquidity. American Airlines only has about 5 months worth of liquidity. Big difference there. So make sure that you do your research there when you're looking at different types of travel stocks, and how much liquidity they have, and how what's their path back to normal look like. Hotels, same thing. Marriott actually reported earnings a couple of weeks ago, and the numbers for hotel guests was actually surprisingly strong. Marriott has been sitting within this range of about 95 or so, and 85, 75, but I believe it's going to break outside of this range, and that certainly puts it in a much more bullish state, putting it all the way up to potentially 130, 132 or so. So you have a lot of potential room to the upside here. So hotel stocks or any type of travel related stocks worthwhile to start taking a look at. I've been bullish on Uber for a couple of weeks now. These are the types of names that you can start thinking about in terms of getting back into investments. Restaurant stocks, Darden Restaurants. This is just an example of a massive publicly traded restaurant group. There are others, and there are also fast casual, whether you're talking about Chipotle or McDonald's or Shake Shack. These are all potential types of names that you might see some kind of pop higher over the next couple of weeks as the data for reopening trends and how fast we're getting back to normal starts to come out and look positive. These are the types of stocks that I think are going to outperform. Darden Restaurants had a pretty big resistance level around 80. You have this bullish triangle, and now we have that breakout. So that breakout is really kind of your bullish indication that a stock like this might rally back up to that 100, 105 resistance level, especially in this type of environment where you have the Fed continuing to pump liquidity into the markets. There's a lot of optimism. There's a lot of momentum for these types of stocks. These are the types of stocks that you might see some moves in. And the one thing I will say is that this is the opportunity to utilize options, because when you expect the markets to break out to highs, a relative all-time highs, and certainly from a valuation perspective, all-time highs, you want to be bullish, but you want to be cautiously bullish, because you want to be always aware of the fact that there are underlying things that that are concerning here. The fact that as the markets continue to push higher, momentum has not moved higher at all. That as we continue to move higher, money flow remains extremely weak. And you guys are aware of the risks, right? You guys are aware of the risk in terms of a potential second wave, escalation with China. There are plenty of, I would say, geopolitical risks that are currently out there. Upcoming election, whatever it is, there's always the risk that you get some kind of quick, violent pullback as you got back here in February. So how do you position for yourself for for the markets to continue to move higher, but potentially prevent yourself or protect yourself if there is another severe and fast, violent crash? And the answer to that is really utilizing options to take these types of bullish bets. So if you're looking at PayPal to continue to move higher, don't buy this. I don't think buying the stock, in my opinion, is the right strategy to do. You can do it, but you're putting on quite a bit of risk there. Using strategies like a put spread, where here, like for example, I'm risking $7.28 for a $150 stock, so I'm only risking 4.8% of the underlying stock price to place that bet. So 4.8% of the underlying stock price, even if the market does crash, the most I'll lose here is about 5% of the underlying stock price. That's the way that I want to take on bullish views here in this particular market. And especially with VIX now below 30, volatility is a little cheaper now. It's not as expensive to buy stocks. So as you can see, VIX opening up around 27 or so. I expect that at the open, it'll actually probably be a little lower, closer to 25 or so. So as VIX continues to move lower, options are becoming a little cheaper. This allows you to buy options now as opposed to predominantly selling options over the last few weeks. So this is really how you want to start thinking about positioning yourself for the markets here going into the open, whether you're starting to look at some of the airline stocks. As you can see, Delta is about to open up about 7% higher, or our hotel stocks, Marriott's about to open up pretty much flat here, but I actually think that you're going to get a nice bump here on the open. But regardless of what type of names that you're looking at, make sure that you think about not only the name itself, but more importantly, how are you structuring that trade? And I think that that's more important. Utilizing options in this particular environment by buying call options is one of the simpler ways to protect yourself, because a call option has limited risk. If you get a massive pullback for some kind of unforeseen event, you will be risking only, in the examples such as PayPal, about 4 or 5% of the underlying stock price. Something more volatile, you will be risking more from a percentage perspective, but you are protecting yourself so that if the market crashes another 20, 30%, that you are not losing 20 to 30% of your portfolio. Now, again, this can go on for weeks. This can go on potentially for months before you do get some type of correction. That's impossible to tell, just like how it was impossible to tell that it was going to be COVID-19 that drove the markets 30% lower. What's going to drive that next sell-off? Very, very difficult to predict. And even if you're able to predict how it happens, I think it's even more difficult to predict when it's going to happen. So as long as the markets continue to grind higher, don't fight the charts, don't fight the Fed, but make sure that you position yourself correctly for a wave lower. So that covers the research that I wanted to show with you here today, and how I think you should approach the markets this particular week based on what we're seeing and how we are positioning our portfolios for the upcoming week. As I have been saying over the past few months, everything that I'm showing you here is as of right now. Things do change very quickly. What I'm saying here this morning may be changing completely tomorrow if there's some massive news that comes out. So be very careful in terms of how you position yourself. Options is one of the ways that can help you limit your risk. And that's really the name of the game at this point when things get stretched at these types of valuations, when things feel a little, when you feel the disconnect between where the markets are trading and where economic numbers are. The best way to protect yourself is making sure that you have strategies that have limited risk that allow you to continue to play for this upside, but do so in a way with limited risk. So with that, I want to thank everyone for taking the time out here this Tuesday morning. I hope that you guys find this useful in helping you better understand how to set up your day and how to think about positioning and what type of stocks and sectors to pay attention to. So we will be back here next week to provide you another update, but I hope you guys have a great trading week, a great Tuesday, and I'll see you guys next week. Thank you so much.